Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello everybody, Charlie Jewett here with Renovating Retirement. This is going to be the first of 7 short podcasts that are Aladdin themed. I'm going to try to release them all about the same time, but recently my family and I went to see the new Aladdin with, of all people, Will Smith playing the role of the genie instead of the late great Robin Williams. Will Smith's from Philadelphia, just like I'm from Philadelphia. Will Smith actually was in my dating profile that allowed me to land this beautiful woman next to me. Say hi, everybody. Hi, Abby. Hi. Yay. Will Smith was in my dating profile, which at some point I'll probably post somewhere just so you can get a kick out of it. But this new Aladdin was actually pretty awesome. Very, very different take on things. It's not a cartoon. It was, people. There were some new songs that brought us to tears. It was really, really cool. And actually, I didn't know if Will Smith was going to be a satisfying genie or do a good job, but I actually really liked him. Thought he did a great job. So I felt inspired and wrote 7 little episodes and thought, well, this is another way to teach kind of some of the things I teach or maybe some new things. And so let's go ahead and jump into these little episode McNuggets, we're going to call them. So the first one is episode 154, A Whole New World of Options. And what we're talking about here, you've heard me say it a couple of different ways, but I mean, everything's changed. A buddy of mine, Andy Guzzi, and I are going to write a book called Don't Settle for a Used Retirement, USED, where we go back and look at, everything has changed in the world since the time that the traditions for what to do in retirement planning were formed. Pay off your house, postpone taxes to a later date, put everything in stocks, bonds, and mutual funds because risk is worth the reward. All of that has changed. All of those traditions and beliefs were formed in multiple decades previous to now. They certainly were not formed from the year 2000 to the year 2018 in the most recent, basically 2 decades. And also, there's new options in every one of the areas of financial planning: mortgage plan, estate plan, retirement plan, insurance plan, and tax plan. I mean, we just had the biggest change to the tax code in over 35 years. So the whole world has changed, and I want you to understand that there's new options. So let's just do a little quick kind of survey or a highlight of what has changed and all these new options that are available. It's all so magical. It's amazing. Mortgages. Let's look there first. In the mortgage world, it used to be that mortgages were expensive. They had kind of high interest. So if you go back and you were paying, 7, 8, 9, 10%, or in the 80s, some people were paying 12, 13, 14. I think Tony Robbins says his first mortgage was at 18%. If you had a mortgage and the interest rate you were paying for that debt cost more than you could earn on your assets. So say you had $100,000 sitting in an investment account and $100,000 left on a mortgage at 10%, let's say. If your investments weren't making 10% and you were having to pay 10% to use someone else's money, then yeah, it made total sense. Everybody should have agreed, and did for a while, that you should take money out of the investment account or take cash or whatever and pay off that mortgage and try to be, quote, debt-free. But it wasn't because debt is bad. It's not because mortgages are dangerous. It's not because your life is somehow worse if you owe a bank some money. It was very, very simply, you couldn't make 10% in the investments, and it was costing you an actual real 10%. So it was fiscally responsible to just pay off the mortgage and save yourself 10% interest, and then go try to earn money somewhere else or have no mortgage payment. The thing that's happened in the mortgage industry is interest rates have come down so low that everybody kind of questioned this and went back to the drawing board like good financial advisors do. Good financial advisors, good, smart, intelligent people don't get stuck in traditions and stay completely committed to something that was true 50 years ago. We're constantly looking at the new data and saying, well, what's true now? Is there any change to the tradition? Do we need to make any different recommendations? It's dynamic and always alive and changing. Well, when interest rates came down way low into the 3s, in 2005, you guys probably know I discovered the book Missed Fortune 101 by Douglas Andrews. Douglas Andrews is the one that originally trained me in 2005. And there was a whole section, there's 3 chapters in there on why to never pay off your mortgage, why to never make a down payment, why you want to keep your money sitting in investment accounts or assets or life insurance or annuities or whatever, and keep that mortgage there so that you have the tax deductions. Home equity fails all 4 tests of a wise investment: liquidity, safety, rate of return, and tax deductions. You can go back into, I think, my episodes in the 70s or 80s or something like that. Not the decade, the 70s or 80s. I haven't been around that long. Goodness gracious. Only 2.5 years. But if you go back to number 73, 74 or whatever, you'll see I have, 6 or 7 episodes on home equity planning. And there's one on each of those tests: liquidity, safety, rate of return, and tax deductions. long story short, I'm not going to redo those episodes on this short little episode McNugget, but the entire world of mortgages has changed, and the advice that we give in the area of mortgages has changed. You really should not be taking money that could be in life insurance or annuities making 6, 7, 8%. If you can make that in the market, good for you. But there's no guarantees there. There's no safe track record there that we're seeing. If you can make even 5 or 6%, and you have a mortgage that costs you 4 or 4.5%, it doesn't make any sense to take $1 and kill it. Stop it from earning compound interest for the rest of your life. Stop it from being liquid. Stick it inside of a house where it's trapped. You can lose it to depreciation to try to save a lower interest rate. I mean, you go all the way around the mountain. You read a 250-page book like Douglas Andrews, or you watch my 1-hour-long home equity planning workshop, my live workshop. It's the only one where I'm wearing a suit. So if you go to watchcharlie.com, my YouTube channel, hit videos, and then just scroll down and look for me standing up in a suit, you'll see me teaching for an hour in Utah. You get all the way around the mountain, do all your research, and go, oh, this is actually really easy. And this is how the wealthy look at it. If my investments earn more than my mortgage, don't pay it off. If my mortgage costs more than I can earn on my investments, do pay it off. It's that simple. Debt is not bad. There's all that junk, all those lies and misunderstanding about debt have been thoroughly exposed and trampled. So mortgages have completely changed. There's an entire world of new options. And for me personally, I'm hoping we get the 40-year mortgage or even the 100-year mortgage like Japan has, because frankly, the longest mortgage possible with the lowest payment is the safest mortgage to have. How about the stock market? There's an entirely different set of options in the stock market than what our parents and grandparents had. Our parents and grandparents kind of had, straight stocks, bonds, and then mutual funds came around, right? Well, they came around like 1924, I think, so it's really not fair to say that they were brand new, but there weren't very many of them. I think there was only 19 mutual funds during the Depression, and then there was like 8,600 in, 2013 or whatever, whoever measured that one. But the stock market has all kinds of interesting new options. Vanguard has kind of proved this. One is just inexpensive index funds. I'm sort of in the middle of an eternal series on Tony Robbins' book because the book is so stinking long. I have trouble even preparing those episodes, but I'm in the middle of that book, and he talks about, Warren Buffett, like all of the greatest minds in the trading world are saying the same thing. Just if you're going to be in the market, buy the index funds. Don't give your money to a money manager. Don't pay somebody to gamble for you yet. If you listen to all my episodes in the trenches with Andy Guzzi, in the trenches with Abby Duenas, in the trenches with Nate Miller, where I'm actually talking to investors who are out there in other cities in the field, meeting people every single day, what are you going to find? Almost everybody, I'm not joking, almost 100% of the people that I've seen in 14 years and the other people in the other cities, in Kansas, Nate says the same thing. In Chicago, Andy says the same thing. Abby works here in San Diego, meeting clients for my company. She says the same thing. Ian Grove in Honolulu says the same thing. Almost 100% of the people that walk in the door hand us a statement, and their portfolio is being managed by somebody at Edward Morgan Lynch or one of the other smaller companies that don't have the that big name, where you're paying a fee for someone to put you into mutual funds, and yet all of the experts are crying from the rooftops. And then Tony Robbins writes a 660-page book on it saying, if you are going to be in the market, you're better off just buying a low-cost index fund. So those index funds didn't exist 200 years ago, 100 years ago. Those are a newer option, especially the lower cost ones. And then you also have other things like separately managed accounts instead of mutual funds, or ETFs instead of mutual funds, or REITs, real estate investment trusts, things like that. So in the world of the stock market, actually there's some really interesting stuff I'm studying right now. I won't comment on it until I'm done, but Tony Robbins talks in his book about real estate investment trusts and different funds that are based around the fact that this aging community of 11,000 baby boomers, turning retirement age every day, creates an incredible need, for the next 20, 30, 40 years for nursing homes, assisted care facilities, and things like that. So doesn't it make some sense to invest in funds that are putting money into those booming industries? So I certainly don't have any recommendations. That's not what the podcast is for. It's edumatainment. It's for having some fun, learning some things. But that makes sense to me. Those options didn't exist and would not have made sense when the baby boomers were eating baby food and Gerber was exploding. It wouldn't make sense to invest in nursing homes necessarily when the baby boomers were going to school and all these schools that we have all over the place were built. The housing boom, they've driven up different industries, and they will probably drive up kind of the medical and the nursing home and assisted living industry. So that's an interesting area that I'm looking at. That didn't, the need didn't exist, the opportunity didn't exist, and therefore the funds didn't exist. And now we have new options. Let's go to annuities, the bad word. I mean, you guys hear me talk about annuities all the time because I refuse to be an ignorant financial planner who goes, I've heard bad things about annuities, so I'm just going to say bad things about annuities and never do any research and just be a jerk. I'm not going to do that. I was an electrician. I had a whole tool belt full of tools on my hip. It's probably why I have back problems, but I had, a hammer hanging from there and some diagonal cutters and a knife and several different screwdrivers and wrenches and yada, yada, yada. Probably 16, 17 tools on my hip within, reaching distance. Remember the old westerns where they reach for their gun? There's not room in this building for the two of us, or what is that thing? That's more like Close Encounters of the Third Kind. I can't get it right. Whatever. So I had on my hip in my holster these important tools, and then I had an entire van full of other tools like a hammer drill if I needed to drill through 16 inches of concrete or whatever it is. I don't hate any tool, and you've heard me teach this. Anybody that comes out vocally and says things like, I hate annuities and you should too, you already know that person's immoral and trying to steer you into something else, because there's nothing wrong with any tool. I don't use whole life, never have, quite possibly never will, but I don't hate whole life. I'm not saying whole life has no purpose in the world. It's useless and I hate it and everybody else should. I've just found that the other type of insurance can do what whole life does and then be tweaked, and we can lower the expenses, and it does the things that whole life does better than whole life does, right? Which is, by the way, why E.F. Hutton created it. Whole life already existed when universal life was created. Why would they create another one if whole life answered every single problem in every person's life? No, they said, what are the weaknesses of whole life? What does it not do well? What do we wish existed that does not exist yet? And then created universal life. Well, let's not talk about life insurance yet. Let's jump back. I'm getting ahead of myself. Darn it all. I'm so fast. Let's go back to annuities. Why do annuities have a bad name? And why do people... I wish the insurance companies would just stop using the word annuity and call it some sort of a, guaranteed income contract or whatever, because the word annuities is like tainted. We have to fight every day. You've heard the episodes I've done. How much income do you want? $7,000 a month. Would you like it to be guaranteed or maybe income? I'd like it to be guaranteed. Okay. Well, you want an annuity? Nah, I really don't. Let me go home and think about it. Wait, what? I'm about to have an incredible deep dish Chicago pizza with my girlfriend. I'm here in Chicago recording these podcasts. We're about to have an incredible deep dish pizza. I don't know if you guys had the pizza from Giordano's in Chicago, but it's dreamy, awesome sauce. Literally, the sauce is awesome sauce, and everything else is awesome too. I'm not saying I feel like I want to run a marathon afterwards. I actually have to have a 3-day nap after 2 slices, but that's okay because my room has a bed. Annuities have a bad name. Why? Well, because it used to be that annuities were kind of crappy. Annuity means contract, and it was a contract with an insurance company where you give them your estate. It really was the surrendering of your estate. I don't need my money anymore. You guys take my money. What do I want? I want a paycheck. Why do I want a paycheck? Because I just came out of working for a company for 30 or 40 years and kind of got used to having a paycheck every month. Now I just have $400,000 sitting in the bank or sitting in an account somewhere, and I'm like, I don't know what to do with that. How do I turn that into a paycheck? And for, some people could do that. Some very, very, very disciplined people who are good at investing could probably not take out too much money, take out just the right amount of money every 2 weeks or every month, make wise investments, keep their expenses low, earn more than the income they're taking, somehow cover inflation, so they're taking an increasing income yet not running out of money, track all the taxes, and then die before they run out of money. Yeah, some superstar out there might be able to do it, but not the average retiree, not from what I've seen. So it was very convenient for people to say, I don't want a big fat chunk of money sitting in the bank trying to live off of it and not knowing how much to take or where to invest it. Let me just give it to an insurance company, let them worry about all that, and they just give me $7,000 a month. Well, that's all the good news. Personal pension is awesome. We love a money tree. You go to your money tree, can I have some money? It says yes. You go next month and say, I spent it all. Can I have some more? It goes, of course you can. I love you, money tree, and you become a tree hugger. It's awesome. But what was the dark side? Luke. What was the dark side of annuities? If you died early, and that happens to people, right? I have a dear client I love very much who had a brain aneurysm and died out of nowhere, with no warning. He's one of my favorite people in the world. Not everybody lives to 95 and dies peacefully in their sleep without any medical expenses. Some people drop dead suddenly. Some people get some really expensive stuff, medical expenses, which we'll talk about, and kind of fade out. If you bought the old annuities and you turned on that beautiful money tree income, but things didn't go as planned and you passed away, let's say 2 years into it you passed away, all of the money you gave the insurance company stayed with the insurance company. There was no death benefit for your loved ones. There may have been, if you picked the right type of annuity, you may have had a survivorship income for your spouse. But the heirs, the kids, are the ones really that have given annuities bad names because a bad name because their inheritance was stolen from them is the way they feel about it. The parents knew about it. They made a decision and they didn't think they were going to die. But think about that. You're on an annuity income, the old style, and Social Security. Two parents, both on annuity income, both on Social Security. They're in a car wreck. They both pass away. Both Social Securities stop. There's no continuation for kids on those, of course. And both annuity incomes stop. And the estate was given to an insurance company that now keeps it. Of course, there were some kids that were kind of ticked off and upset. So annuities got a bad name. But the word means contract. Contracts are infinite. It's only based on whatever the terms of the contract are, whatever the words actually say, right? So to say that annuities have more options now than they did 10, 20, 30 years ago is such an understatement. I mean, literally today, you can buy an annuity with almost, well, I can't say infinite terms, and I can't say any terms you want, but almost everything you'd want from a contract besides 100% liquidity you can get from an annuity. The insurance company does need the money for 5 to 10 years or else they can't make any money. So the only reason this beautiful thing even exists is because the insurance companies can make some money if we leave the money there 5 to 10 years. Well, that's easy. If it's a source of income, would anybody want to spend your entire source of income anyway? You're like, I've got $500 to live off of, and I want 100% liquidity in case one day I want to spend $500 on something and leave myself destitute with no income. No. I've always found this just to be comical. We talk to people about the income they want. I want $5,000 a month. Okay, let's move over, let's move $450,000 over here into this annuity. Well, how long do I have to leave it there? I don't know. How long did you want income? Was there some event coming up in the future where you felt like you might want to spend your entire nest egg that took you 30, 40 years to save and then leave yourself with no income and no nest egg? Is that realistic? No, I'm just looking for the perfect investment and I want to destroy my joy. So I want to find what's wrong with everything and complain about it. No, what do you mean? Like there's two ways to make money. Put your investments at risk, stock market, real estate, buying goat farms, whatever you want, trading baseball cards. So you risk your principal, or you commit to a time frame, right? You give somebody a mortgage for 30 years. You buy a CD for 5 years. You buy an annuity with 5 to 10 years of surrender penalties. You buy a life insurance contract with 5 to 10 years or 10 to 15 years of surrender penalties. The committing to a time frame is one of the most easiest ways to make money. Like, listen, you guys can use the money for a while. My point is, you don't need 100% liquidity. Surrender penalties are not bad. They're beautiful. They're genius. The only reason we have these incredible income tools is because of surrender penalties. And the hatred of surrender penalties or being uncomfortable with surrender penalties is not even straight thinking. You would never, ever want to spend all of that money in one place anyway, so why would you need it all liquid? You would hurt yourself. You're being protected from you, honestly, from surrender penalties. Now, today's annuities have all kinds of awesome options. If you do have some liquidity issues, like you need to spend some of the money, you can usually take out 10% with no penalties at all. Well, 10% of a nest egg is quite a lot of money. It covers every emergency I've ever seen. So today's annuities give you guaranteed income for life or guaranteed increasing income. No losses when the market goes down. Gains when the market goes up that are super fair. They're averaging more than the stock market. You can cover income for two spouses. Some of them give you double income for long-term care. Nice. That's awesome sauce. What else? When you pass away, every single dollar that's left in the contract goes to your heirs. So the whole new world of options in the options. I have to talk like that because I'm in Chicago. I don't know why. The whole new world of options with annuities is that they've taken the bad away, which is that they don't keep all the money when you die, and added all kinds of amazing features, guaranteed income, no losses. Lots of annuities have no fees at all. I definitely have not talked about that enough on the show. Having no fees in your investment accounts, you really cannot. What's the word I'm looking for? It would be hard to say how important that is or what a difference that could make in somebody's life to pay no fees versus paying fees. Okay, enough of that. Life insurance. What did life insurance used to be before E.F. Hutton? Life insurance used to be an expensive way to cover an important need. If you don't love somebody, you don't need to buy life insurance. But if you love somebody, you probably need life insurance. What do I mean by that? I was a sole breadwinner in the marriage that I was in when my children were born in 2003 and 2006. I was the only person working. I looked at how much money I was making and said, what if I died? How would they have that much money? How would they keep getting that same income? And I just took the income, divided it by 5%, and said, well, here's a chunk of money that if it went to the kid's mom, she could invest it making 5% a year and have the same income as if I was around. So I basically was saying, how do I replace myself or how do I replace my income? What chunk of money? And I bought life insurance for that amount and still have that amount to this day, even though my kids are turning 13 and 16. Because now it's more like, what if I died? How would they pay for college and things like that, right? Buy their first house, whatever. So life insurance used to be an expensive way to pay for something. Everybody did it reluctantly, like, I need this. Like, what's the cheapest way to do it? Along comes E.F. Hutton in the late 70s, I think it was, early 80s, and says, hold on, I just found out that money grows tax-free inside of life insurance. This is before we had Roth IRAs, and said, well, that's kind of a cool tool, especially for the wealthy. Let's grow money completely tax-free, never pay taxes again on it. All of a sudden, this whole world of universal life then turned into variable universal life, which has a really nasty history because the insurance agents were lying about what the earnings would be over 30, 40 years, or exaggerating at least, and then turned into index universal life, which is a fascinating world of amazing tools. All of that came from saying, wait, there's a feature inside of this where you can grow money tax-free. So the world of options in the life insurance industry, the new options, is incredible. Incredible. I mean, you can give an insurance company $80, $90, $100,000 one time, just like funding a bank account, and use it as an alternative bank account. I call it, if you go back and listen to my podcast called What the Heck is a Mech, or if you look up In Case Accounts, there's a podcast called In Case Accounts. You can look up and study on this. There's actually videos I've done at watchcharlie.com. You can go watch the In Case Account video. I don't use banks. I don't leave a ton of money in banks, maybe $5,000, $10,000, $15,000, and I just call that the urgency fund because ATMs are convenient. Other than that, banks really don't do anything that I want. They're not paying high interest. There's just nothing exciting about them. But if I give money to an insurance company and buy what's called a single premium life insurance policy with return of premium, meaning no penalties if you want to cancel, what do I get? I get downside protection when the market goes down. I don't lose a penny. Upside potential when the market goes up. I might get the first 8, 9, 10, 11% of it. So these things can average, 3, 4, 5, 6%. If I ever want the money, I get it back with no penalties. So guaranteed all of my premium or all of my premium plus minimum returns, which some companies offer, which I really, really like. One of my favorite companies offers a 2.5% minimum as long as you've left it for a year. Minus the cost of insurance, which we scoot down to 1%, 1.5%, whatever it is. But if I can make over 1% of my money with potential of making 3, 4, 5%, get it back whenever I want to. If I die, my family gets 2 to 3 times as much as I put in. I like that. That's an option that didn't exist in the past. And then the option, of course, the basic traditional rich man's Roth IRA. You can fund life insurance instead of funding IRAs and 401ks. When you get to retirement, all of the income or all the distributions you take out to pay your bills, don't choke on your fettuccine compliance, guys. Don't say income. I don't know why. Only in the good investments, you're not allowed to say what they actually do or use actual true English words. You have to dance around it because somehow that's better for the consumer to be complicated and not use the words they're used to. But life insurance, when set up properly, the distributions are completely tax-free, just like a Roth IRA. That's why it's called the rich man's Roth IRA. That's why when you study wealthy people, they're all in life insurance. That's why Tony Robbins has an entire section on life insurance and got into the business and partnered with a life insurance company that I'm a part of. It's the way it is, right? Life insurance grows tax-free, and that's awesome. And then I'll say, last piece here, leverage. Banks will actually lend you money to put into these life insurance policies. So not perfect numbers, but if you were going to put in, $40,000 for 5 years. And I don't mean you make so much money you can save $40,000 a year, although a lot of you do. I just mean you have $200,000 sitting somewhere else that's inferior to this. It's in a brokerage account, or it's in an IRA and you want to pay the taxes and get it over with, or it's in a house you sold or whatever. You end up with $200,000. You want to put it in over 5 years. So you're going to do $40,000 a year for 5 years. Very rough numbers. Instead of putting in 40 for 5 years and totaling $200,000, the bank will lend you enough to put in almost $800,000. You can get almost four times the money you were going to put in into the policies. That's how much the banks believe in these things, and they use the policy as the collateral. So banks aren't trembling at the knees going, oh my goodness, what if the insurance companies go out of business? Because they know they haven't, and they know why they don't. For heaven's sakes, they're the banks. They're the ones that do go out of business, and they've watched as their partners go out of business when insurance companies don't. So anyway, you can do modified endowment contracts or a better bank account. You can do tax-free income. Oh, don't call it income. Tax-free distributions to pay your bills. Or you can do leverage, where banks will lend you money so you can get 4 times as much into these, which gives you 4 times the death benefit. And after you pay the expenses, probably gives you 50-60% more retirement income for the same premium. I love it. How about real estate? Real estate has changed dramatically. There's a whole bunch of new options in the real estate world, and you've probably heard me interview Chris Prefontaine or Zach Beach, who's Chris Prefontaine's son-in-law, married his daughter. They're doing some fascinating things in the world of real estate investing, and they're using a bunch of different pieces that I knew existed, but they put them together. They put them together in a recipe. It's averaging like $72,000 per deal, getting paid 3 or 4 different ways over a 3-year period. Incredible. I've been to his boot camp. I'm going again this year as one of the speakers. I have his course that you can buy. I think it's like $995, or if you buy it, you go to the boot camp for free and don't have to pay that, or you go. They have all kinds of amazing deals. Look up Smart Real Estate Coach Chris Prefontaine, and also Bill Manicero. The stuff he's been teaching on my podcast, I interviewed him twice. And the world of real estate just has all these other options, including real estate investment trusts and being silent partners. I'm going to do a whole episode on land banking, which I didn't even know what land banking was. And now I'm working with one of the top land banking companies in the country. Really, really cool stuff in the world of real estate, new options. And then last but not least, I always say these podcasts are going to be short, and then I yak for 20 minutes. I don't know what's wrong with me. Hey! Long-term care. Long-term care used to be when you get sick, you go live with your family and they take care of you. Nice. Then it turned into there's facilities and things like that, but they're crazy expensive. I think the average most of us use is like $8,000 or $9,000 a month for a private room facility. Now, you could just go and have a nice half room with a curtain between you and the guy dying next to you and be in a Medicare facility, but I just don't know if that's how you want to finish your days on this beautiful planet. So those high expenses, insurance companies said, oh, well, let's tell people we'll pay for those as long as you pay us. So they come up with long-term care insurance, the traditional long-term care insurance, which I did a little bit of in my early days. Well, long-term care insurance turned out to be kind of a pickle because no one knows what medical expenses are going to be, and the insurance companies are allowed to raise the premiums whenever they want to. So I'm not joking. I have seen monthly premiums go up 85% in 1 year. So somebody that's paying $400 a month, next year they might say it's $700 a month or whatever. It might double. That's sort of at their discretion. So that's a very difficult pill to swallow. Say, I'll pay you hundreds of dollars a month and you control how many hundreds I have to give you, and we'll just see what happens. So long-term care, the options have changed tremendously in the last 5, 10, 15 years. My favorite options right now are these. Don't pay for long-term care. Do your in-case accounts, your income accounts, and your increase accounts in such a way that someone else will pay your long-term care by saying, thank you for letting us manage your money instead of giving it to Edward Morgan Lynch. You can put your money in the banks, you can put your money in the market, or you can put your money in insurance company products. They've each had their heyday, right? In the previous century, banks, there was a time where you could stick money in the banks and make 8% on CDs and just live off of it. That stopped working. The market did really well from 1970 to 1999. Diversified portfolio, paid 13.5% average. That's awesome. 2000, that stopped working. From 2000 to 2018, the world of insurance products has changed dramatically. Now they're doing an amazing job, particularly for the age group or for that season. You don't have to be 50, 60, 70 right now. You can be 20, 30, 40, but there'll come a time. This is what retirement planning is about. There'll come a time where you are, and we're planning for that season. Insurance companies have gone out and done a better job in solving the problems of retirement for that season. You could do your in-case account in such a way where, hey, money's liquid, money's growing. If you want it, you can have it back. If you go into long-term care, the insurance company will pay 2 or 3 times more than you put in towards your medical bills. Well, that's awesome sauce. You could do your income account where you have an annuity, say it's paying you $4,000 a month, and you're with an insurance company giving you that annuity, of course, and they say, if you go into long-term care, you go into a nursing home, or you need to bring somebody into your home to take care of you, we'll double your $4,000 a month to $8,000 a month for up to 5 years. Well, that's awesome sauce. My broker's not offering me that, and my bank never even talks about it. Exactly right. Brokers, the market, and banks don't offer anything for long-term care besides, spend your money as long as you have it, and once you're out, you're done. So income accounts, or in-case accounts and income accounts, both can do incredible long-term care things at no cost to you. They just come along for the ride as a thank you. And then, of course, this tax-free retirement planning or this leveraged premium financing idea using the same tax-free retirement vehicles can do the same thing. They'll say, if you do your growth with us instead of with the stock market, and you happen to go into long-term care, we're willing to pay 2, 3, 4 times as much money as you've even put in towards your medical bills out of our pocket. And sometimes it's completely tax-free because it's an accelerated death benefit. The whole world of long-term care has changed. So mortgages, the stock market, annuities, stock market I didn't mention, but it didn't used to be that you could invest in the stock market and have no fees, no losses, and a whole lot of the upside potential. So most of the upside with very little or none of the downside, or most of the upside with none of the downside, did not used to exist. Mortgages, stock market, annuities, life insurance, real estate, long-term care have all changed. There's a whole new world of options. And that's all I got to say about that. I think you people are the best. Bye-bye.
Renovating Retirement with Charlie Jewett.
That's all, folks.